Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Messer and Tim Stenevec from Bloomberg Radio.
All right, first Fed Minutes top of mind. Let's get to those minutes from the last Fed meeting. Let's head to our Bloomberg News International Economics and Policy Correspondent, Michael McKee. That's the May 1st meeting. He's live in D.C. at the Federal Reserve. Mike, over to you.
Well, the big question for Fed officials at their meeting 3 weeks ago was how much higher interest rates are affecting the economy. Although monetary policy is restrictive, the minutes say, many participants commented on their uncertainty about the degree of restrictiveness. High rates, they felt, might be having smaller effects than in the past. The neutral rate, or R star, might be higher than previously thought, or potential growth might be slower than they had estimated. For now, the decision was to maintain the current policy path for longer should inflation not resume falling. But various participants mentioned a willingness to tighten policy further should risks to inflation materialize. They noted disappointed readings on inflation over the first quarter and indicators pointing to strong economic momentum. There was also concern about risks to financial stability in a higher inflation environment, including unrealized losses on assets, high commercial real estate exposure, significant reliance by some banks on uninsured deposits, and cyber threats. Several participants commented on the rapid growth of private credit markets, warning they should be monitored because some risks from those markets may not yet be apparent. The overall economic assessment, though, pretty much as you've heard from Fed speakers over the past 3 weeks, they expected inflation to continue falling towards their 2% target, but were disappointed by the apparent stall in the first quarter. That reduced their level of confidence in what was happening. A bit of a list of what they're looking for going forward is in the minutes. Lower readings on rent growth for new leases, a decline in wage growth in non-housing services, and perhaps higher productivity. There was general agreement that higher rates of immigration were keeping labor markets relatively tight. Nothing basically that we've heard since then changes the outlook, and nothing in these minutes really disabuses the higher for longer narrative, guys.
All right, Mike McKee, of course, there in Washington. Mike, we're going to come back to you in just a moment. We do want to do a quick check on the markets. I'm looking like there is a little bit of move to the downside. Let's start with the equity trade. You've got the S&P down about 17. It was down about 14 heading into the Fed minutes. The Dow was down about 138, now down about 168. And the NASDAQ 100 was down about 34, now down about 50 points. So we are seeing equity losses steepen a little bit right after, as Mike went through those Fed minutes. Looking at the Treasury curve, of course, more important in terms of what the Fed has to say, but the 10-year was yielding about 441. We're now looking at 442, so maybe a slight tick up there. 5-year note was yielding about 445, now at 446. And the 2-year, certainly the shorter end of the yield curve, always most sensitive in terms of what might come out of the Federal Reserve. That 2-year note was yielding 486, now at 487. So really, Mike and Tim, really some slight movements here.
Hey, Mike, help us decode a little bit of what these words actually mean here. In the Fed minutes, quote, many uncertain about the degree of restrictiveness, and, quote, various participants willing to tighten more if needed. Is many more than various?
You just hit on one of the sore points in the lockup today. There is a sort of semi-official Fed list of these adjectives and what they mean in sort of a ranked order for the amount of participants they're referring to. But various is not on the list. It was pointed out to Fed folks today. And they said they would try to get us an answer on where it is on the list. Now, we've heard from a number of members of the Open Market Committee that if inflation started to go back up, was a danger, they would be willing to raise interest rates. So that's not really a new thought, and it is kind of logical that it would come up in their discussions at their last meeting. But we don't have a number to put on or a way to tell which is a larger group.
Mike, anything, okay, so there was the Jay Powell presser, and my understanding from what Anna Wong said earlier, just ahead of the minutes, that the Fed does have some discretion on what they show in the minutes. But so I'm wondering, in terms of what came out in the minutes, what we've been hearing from Fed speakers, I think there's been 50 officials or so since that May 1st meeting. There's been a lot of talk, if you will. I don't know, is everything kind of coming together on message, or I don't know, how do you see it?
Well, that's also interesting, Carol, because they did talk about their messaging and, according to the minutes, generally felt that Americans understood what the Fed was trying to do, and they needed to keep hammering away at it, but they seemed pleased with their messaging and their communications policies. So they're hoping that, I guess, translates through to some sort of additional reaction. They do note that inflation expectations have stayed pretty much anchored, especially at the longer end. And so they didn't feel, there was no indication that they felt they needed to change or emphasize anything in particular.
So higher for longer, high for longer, and yet anything in terms of, as we said, kind of ahead of this, that Jay Powell had a lot of opportunity to talk about, if we needed to maybe even raise rates again. Anything around that we got a little bit more on, or not really?
Not really. In general, the minutes reflect what we've been hearing from the members of the Open Market Committee over the last 3 weeks, that they were disappointed in the inflation numbers. It took away some of their confidence that they might be able to cut rates sooner, and they feel like they need to just stay with higher for longer for right now. Although we did have the mention of various people talking about raising rates, that was only in the context of inflation starting to rise again and having sort of an outlook of problems from inflation that would come from that. It didn't seem like they think that's a very likely possibility, but the risks are still there.
Mike, what's your number one or two questions here that, like, coming off of all of this, so much Fed speak, you were at Amelia Island, surrounded by Fed speakers, all in on Fed policy and conversations, and then here we get the Fed minutes. I mean, what's the top two questions that you've got for Jay Powell?
Well, I'd put it this way. I think the best description of where we are right now and what the Fed's trying to do came from Susan Collins, the Boston Fed president, down at Amelia Island last night, when she said, at the moment, patience is the most important factor. They don't know what's going to happen with the economy. They have some ideas on what they think should happen, but many of them will just admit that they've been surprised over the past 2 years by what's happened in the economy. So they're going to wait and see and try to have enough confidence that once they start moving, they can continue to move. They don't have to go up and down.
Do they get a pass for maybe being uncertain about stuff? Like, I guess I always think, they're Fed officials, they should know everything. But having said that, we're still kind of figuring our way post-pandemic, 4 years out, but we're still kind of working our way through it.
Yeah, that was a topic down at Amelia Island because there's a lot of Wall Street people who attend that conference. And there are people who think the Fed has gotten it wrong and they need to correct course. They need to change their models and their thinking. You don't get a real argument from the Fed that they got things wrong. They admit they got inflation wrong. They're just thinking at this point that the best they can do is wait and watch because the models aren't working, and any kind of precipitous action could only lead to probably more problems than waiting.
Hey, Mike, I got to ask the political question here because Anna Wong just on with Joe and Kaylee earlier, and she mentioned the idea that come July, any rate cut or any rate move seen after July is going to be seen as political. How is that gelling with the conversation in your world right now? How is that seen?
Well, people aren't going to write that idea off, but they're not going to pay any attention to it. If they felt they could cut in September, then they would go ahead and do so, in part because people think they might not. And they might want to make a statement there. But then you have people like Chris Waller last night saying that end of the year maybe, and Raphael Bostic saying end of the year. So there doesn't seem to be an emphasis on an earlier rather than later rate move. And maybe July, September, too early for them. They may not have enough evidence yet that they are ready to move.
Hey, Mike, real quickly, 30 seconds here. Mohammed El-Arian writing a Bloomberg opinion piece on the Fed's uniformity on rates and how that comes with risks. And he talks about whether traditionally thought of as hawks or doves, Fed officials have recently converged to a notable uniformity in their policy, signaling of high rates for longer at a time when Wall Street analysts are embracing a wider band of uncertainty for their projections of economic growth and inflation. Real quickly, your thoughts about that uniformity. Is that a problem in your view?
Well, I don't think it's as uniform as perhaps Mohammed is talking about. You have to realize we're not just talking about the consensus forecast, the median forecast in their summary of economic projections. They have a range, and the ranges are fairly wide, as they are on Wall Street. It's just that the options for them are very constrained in terms of 25 basis points here or 25 basis points there. So there isn't a lot of difference on the policy side, but in terms of what they see happening, there is a kind of a range of views.
Got it. Mike, thank you so much. Michael McKee, Bloomberg News International Economics and Policy Correspondent at the Fed in Washington.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
It is a tale of two retailers on this Wednesday. Target tanking off 10% at its lows today, right now down about 8% after a key measure of sales fell for the fourth consecutive quarter. And the retailer remains cautious about discretionary spending for the coming months. But wait a minute.
There's also TJX. That stock rallying up more than 7% at its high, rising to a record high right now by about 4.2%. This after the Maxinistas were out shopping. The off-price retailer boosted its earnings per share forecast for the full year, with first quarter results, Carol, better than many expected. That, according to Citi.
All right, so let's get to our retail roundtable. With us is Bloomberg Intelligence Senior Retail Analyst Mary Ross Gilbert in our LA Bureau, along with Bloomberg News retail reporter Jaewon Kang in our Chicago Bureau. Hey, Mary, I want to start with you. Let's start with TJX stock rallying in a big way. Walk us through the quarter, the outlook in the business.
Yeah, so when you look at the quarter, as you pointed out, they beat on the earnings line. But on the sales line, when you look at comp sales came in at 3%. That was below consensus estimate of 3.4%, but it was the high end of the company's plan. So that was fine, except usually they like to beat their plan. The reason for the miss was really weather, and it was on the apparel side of the business, where they were a little bit lighter, and it had to do with weather. Other than that, all the other categories across the board were performing well. Actually, home, when you think of home goods, don't think of furniture. Think of more consumable, type homes, home decor. It could be something for the table. And in that side of the business, they actually outperformed. On the margin side, that's where we saw the gains, better than expected. And that really came from higher mark-ons. So this team of buyers are able to really buy. First of all, they're the largest in the off-price space. So they carry a lot of weight, and they have several years of expertise going through a very carefully crafted buying program, so they really know how to buy well. And they have the ability to even implement selective price increases, something you're not hearing from the other retailers. So the combination of that boosted their merchandise margin, and they were able to be more efficient on the freight side by allocating more to rail away from trucking.
Oh, that's
and that was
interesting.
the boost you saw in margin.
So
Yeah.
Mary, does TJX do well no matter the economic backdrop? I know Carol is a big
I know
fan.
me some home goods.
Yeah, she's like talking in a meeting earlier about buying home goods. I'm wondering how that's powering the company's earnings for the most
I hope
recent
John
quarter.
isn't listening.
But does it do well regardless of how the American consumer is feeling because it has this exposure to different retail segments?
Yeah, well, you have to think about, it's not just, having different segments, including home, but home does help. It helps with the seasonality aspect when you get hit by weather. But the other thing you have to know with TJX is that they serve customers that are from the lower income all the way up to, let's say, the upper middle income, and even luxury to a certain extent, because they'll have brands as high as, a Chloe or Versace, but then they'll have Calvin Klein, Trina Turk, Under Armour in there. So
Yeah.
they have such a wide range of eclectic product in this treasure hunt. with multiple shipments a week, so that it really inspires you to go multiple times, because you're always going to find something that's really special. And I think that's their success, their recipe for success.
A lot of designer bags in the shopping carts. I see them all over the place. Jaewon, come on in on Target, because it's a different story for Target. As Tim mentioned earlier, and we talked about earlier, Target is down about 8% as we speak, down 10% at its lows today, but really taking a major hit. Walk us similarly through Target's quarter and outlook, and why it's maybe having a tougher time here, or why investors are disappointed.
Yeah, so Target's comp sales fell for the fourth consecutive quarter, with people staying on the sidelines for discretionary purchases. The sales decline that was in line with Wall Street estimates. Adjusted earnings were a slight miss, but it's worth pointing out that this is a metric that's had consistent beats in recent quarters. And overall, the executives said today they won't be satisfied until they return to growth this year, and that they're on track to do that. But many investors were expecting a bit more, and that's translated to the stock performance today.
What's wrong with Target? What's going on at Target that they're struggling? And I'm just curious, is there something about that consumers are pulling back? It's maybe I don't know if it's a similar customer as TJ Maxx, but what's going on at Target?
It's been on a really interesting path, and I mean in a pretty crucial moment right now. So it was a bit of a darling during the pandemic when people were willing to spend a lot on their homes, but of course that's taken a turn as they started pulling back on those purchases and other discretionary items, with prices going up. Interest rates also remain high, and on top of that, last year their Pride Month assortment drew pushback, and that hit sales as well. So they are trying to get back to growth, and have said they expect it to happen during the second quarter.
I guess I'm wondering if this goes back to the problems they were having in 2022, Jaewon, because they were in the midst of a huge decline in their share price going back to that year. Pretty much historic when we think about it in the context of the retailer. Are they still recovering from that, or is this a new set of challenges?
It's continuation of that. They have also talked about, consumers still being pretty concerned about high prices, high interest rates, upcoming elections, and that's partly why they expect discretionary spending to remain under pressure for the near term. They're seeing lower demand for discretionary products like home goods, what they call hard lines, so things like appliances. And during the latest quarter, they also saw declines in frequency categories, which refer to essentials like groceries.
I want to go back to TJ Maxx for a moment. Mary, I came across a store, HomeSense. Is that another part of their brand?
It is, yes. It's part of the home goods segment, but They have two different brands, Home Goods and HomeSense. So when you think of HomeSense, think of bigger items. So that's going to be like large rugs and maybe an end table and things like that. Things that are a little more bulkier.
Yeah.
That they don't. What they said today is they don't really want to enlarge the home goods stores to be able to capture that market opportunity. So that's why they sort of created HomeSense, and of course it's performing very well as a result.
And is that new, kind of newish? It's the first time I saw it.
It's newish, but not new.
Okay.
But there is tremendous white space for growth there, as you can imagine.
Hey, Mary, these two reports taken together, plus what we heard from some of the other retailers, including Walmart last week, with the idea that the Walmart shopper is actually increasingly on the higher end of the economic spectrum. How would you characterize the American consumer right now? Like, what's the big takeaway from the quarter when it comes to retail earnings?
Yeah, so we're still early in our retail earnings reporting, but the big takeaway, number one big takeaway, is the consumer is resilient. And the reason for that is employment is strong, and actually wages generally higher than inflation. So that's the good news. But I think when you're talking about Walmart and Target, you're seeing a different story, coming into play. And part of that is really that the lower income consumer is still stretched by inflation. So while it's not rising as much, it's still up. It's more modest now, especially on the food side, maybe 2 to 3%. But it's still affecting the lower end consumer.
Jaewon, come on in too on that same thing of the retail sectors and names that you keep an eye on. what are you generally kind of taking away in terms of trends or themes when it comes to the retail environment, and then, what it means for consumers?
Yeah, the earnings season, we're halfway through for the big box guys, and it's been pretty mixed. Walmart talked about the success they're having with, higher income consumers in particular. Their discounts are certainly resonating. Target, as we talked about, struggling with, different sides of the business. So, it's been mixed, and I think the narrative overall for the sector is that, people are resilient, they are paying for essentials and other products that they need, but, still facing a lot of uncertainty when it comes to the broader environment.
Jaewon, very briefly, you also cover food retailers, and I'm wondering the next name on your radar when it comes to reporting, or just when it comes to the important thing for our investing audience to keep an eye on.
Yeah, so Kroger is the next food retail name that's coming up in a couple of weeks. We'll hear from Costco next week. And, those companies, I think, will also give us insight into how people are interacting with groceries, where they're pulling back, where they're spending. So, we'll be busy next couple of weeks.
Yeah, good stuff. Mary, how about for you? On your radar in terms of any other retail to come?
Oh yeah, there's a lot.
There's a lot. I know.
So so tomorrow morning we have Ross Stores, and also tomorrow we have Ralph Lauren. I'm sorry, tomorrow morning's Ralph Lauren. Tomorrow afternoon is Ross Stores. So Ross Stores, if you kind of think of off price, TJ Maxx is at the high end where they'll capture more of the upper middle income consumer. So Ross is kind of in the middle, and then Burlington Stores, which will report the following week, is at the lower end of the spectrum. So where TJ Maxx can actually take price, which means they're increasing prices on select items and not getting any pushback because their price points versus comparable product out there is still low. Where Ross is wanting to bring in more and more brands to attract that trade down consumer from department stores and get that higher income, higher middle income. They are actually reducing prices.
All right, guys, thank you so much. Mary Ross Gilbert of our Bloomberg Intelligence team, and Jaewon Kang, Bloomberg News retail reporter, with our retail roundup.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Well, global spending on the clean energy transition definitely underway. Hit record highs as the world moves to rein in climate change. It is still, though, not enough to get on track to net zero emissions. Total spending, Tim, last year surging 17% to $1.8 trillion. That's according to a report earlier this year from Bloomberg NEF. These include investments to install renewable energy, buy electric vehicles, build hydrogen production systems, and deploy other technologies. Added investments in building out clean energy supply chains, as well as $900 billion in financing, and the total funding in 2023 reached about $2.8 trillion.
Okay, so that's the backdrop here, because one company is tapping into this. Well, many companies are, but one company that is the diesel and natural gas engine maker Cummins, which launched a new brand, Accelera, for its new power business segment about a year ago. Here with more on what they're doing is Amy Davis, president of Accelera by Cummins, joining us from Indianapolis. Amy, good to have you with us this afternoon. As we noted right at the introduction of this, Cummins launched Accelera, your new power business, about 1 year ago, the brand that is. It's a very, very small part of the Cummins revenue pie, 1% in 2023. Small today, but give us an idea of the goal, the scope, the impact of it moving forward.
Sure. Great to be here. We started really in this zero emission space in 2017 through a few acquisitions and got serious about 2 years ago and then launched our brand last year. Accelera is really focused on zero emissions for the really tough to abate sectors, the commercial sectors that are going to be hardest. We are applying our duty cycle knowledge from being in this business for over 100 years and applying that to the unique solutions that are required for commercial applications. And by delivering those, while it's a small part of revenue today, we expect by 2030 it'll be quite meaningful. And we've announced just recently it could be $3 to $9 billion of revenue.
What would be the percentage of the entire company's revenue by the end of the decade?
Well, we also see a significant amount of growth in our core. So this is all part of our Destination Zero strategy. So we see actually bridge technologies also playing a key role over this next 10 years. So like you mentioned, natural gas, different alternative fuels, hydrogen-fueled internal combustion engines also are going to play a big role. So we see a lot of growth actually in the core business along with Accelera, coupling to a Destination Zero, which means how do we get customers, aid them in this transition to give them technologies now and the zero ones so it couples to growth for us, but also the decarbonization for our customers.
So, okay. So but I'm just looking at, like, you guys are at revenues are expected to about 33 billion in revenues this year. So 3 to 9 billion, assuming it grows, it'll still be a smaller business, but you're seeing it growing to be a significant business for the company?
Absolutely. And there's so many factors that are going to impact it, Carol. If you think about the infrastructure that you mentioned in your intro, the infrastructure layout is having a huge impact, especially in commercial applications, because they need that nearby, and it takes their operations down when they have to stop and refuel, whether it's hydrogen or electrification. Also, there's other challenges in just learning how to change their operations with the different ranges that are required. The cost also is really, it's still more. And so that's why we are offering such a broad range, because the adoption rate is quite varied, as you can see. And the big factors are really infrastructure, government incentives, and how those play out, and how the costs come down that curve.
Okay, so the business is essentially two different units. There's the e-mobility unit, which includes fuel cells, e-axles, hydrogen solutions. But then there's also the electrolyzers business, which is really interesting to me. And the whole idea with that business is creating hydrogen using electrolysis. Can you explain exactly how that works and the opportunity that you see there moving forward?
Yeah, so the important thing here is you can really create green hydrogen without using any or creating any greenhouse gases, but it requires a lot of electricity. And so to make it work, you do need to couple green energy or renewable energy investments along with it. But the electrolysis technology is scaling quite quickly. And I see that as a really huge part of both our revenue, but also the enabler for hydrogen infrastructure full stop, and even things like hydrogen combustion engines as well as fuel cells.
How do you get the hydrogen from these electrolyzers to clients?
Yeah, so that's still playing out. We're seeing a lot of different models playing out, but really liquid hydrogen is going to have to be the key here. And then you can leverage some of our current infrastructure of pipelines and other things to actually move it. And we're seeing projects of ammonia as also a transfer mechanism, perhaps overseas. So you can go from places where there's really low cost renewable energy, like the Middle East, for example. Texas is interested in playing a role in this for export, and then transporting it via ship in the form of ammonia. So there's lots of invention happening in this space and lots of models playing out.
Amy, excuse me. You recently lowered your long-term targets for Accelera. As the transition to the zero-emission vehicles, it's going slower, right, than everybody had expected, you guys as well. What are the biggest barriers to increasing EV specifically and the adoption rates when it comes to the commercial vehicle market?
Yeah, so 2 years ago was when we first made a revenue projection in this space. And I don't know if you remember 2 years ago, there was quite almost just a hype really going on. Lots of new entrants in the space, really ambitious revenue goals from startups, people doing SPACs. And we've seen that play out now over the last 2 years as the realities have sunk in and what it really means to access the funding. So that's the first thing I'd say. Accessing the funding that's available is taking longer. And there's still a lot to play out in terms of specific rulings of how the tax benefits will be applied from the IRA, for example, and how IPCEI's funding in Europe. So that's one. Two is actually the supply chain. It's really taking some time to build out the supply chain while there have been electrolyzers for a long time, not at the kind of scale that we're talking about. So both supply chain in the manufacturing of the equipment all the way through to the plant construction and getting the EPC companies geared up and ready to go. So infrastructure build out and funding are two key barriers, I would say. And then just getting the costs down and the operational impacts adjusted to from our fleets and the end customers.
So just real quickly, just 20 seconds, because we have one more question we want to squeeze in. How quickly does all that come together? Are we talking 2 years, 3 years, 5 years, 10 years, or longer, or shorter?
Well, I see a key pivot point in the US here in 2027 and in Europe in the latter half of the decade as well, because we see emissions regulations coming in that will tighten and increase the costs on diesel solutions, while at the same time we are gearing some of our next gen products, and our OEMs are as well, for that window. So I think 2027 to 2030, we'll see a pivot point.
Is the whole idea here in our lifetimes that this will eventually be Cummins' entire business? Is that a possibility?
I think some of these tough to abate segments might really struggle till the 2050 timeframe, but in commercial vehicle applications, it's going to happen. I'm convinced we have the technologies that can pull it together. It might be 2040 before we really see the full scale adoption, but I think we have the technologies to make it happen.
20 seconds left. Any tech or product gaps in the portfolio that you have right now where you could look toward making acquisitions like you did in the past few years?
We're always looking at different things coming on the market, but I would say right now we've nailed the portfolio that we think it's going to take to really lead the transition for commercial applications by giving them multiple paths to get it done and get it done correctly for their operations.
All right, going to leave it there. Hey, Amy, thanks so much. Amy Davis, president of Accelera by Cummins.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Small business, you hear it all the time, but it really does power a huge part of the U.S. economy. The country's 33 million plus small business companies were responsible for almost 2/3 of new jobs from 1995 to 2021. This according to the U.S. Chamber of Commerce. Someone who has a finger on the pulse of small business is Aparna Khurjekar, Chief Revenue Officer of Business Markets and SaaS over at Verizon. Aparna joins us on the program right now from Hawaii. Aparna, good to have you with us this afternoon. We love talking to folks like you because you do have a good view of what is happening in the U.S. right now. And that's exactly where I want to start, because you do oversee a lot of the small business at Verizon. And I'm curious what you're hearing from clients and seeing from clients right now when it comes to the numbers.
Yeah, absolutely. And thanks for calling out. Firstly, really, really happy to be here. Thank you for calling out. SMBs are truly the backbone of the U.S. economy. 99.9% of businesses in the U.S. are SMBs, anywhere between 1 to 1,000 employees. So that's a huge diaspora, but they have some very, very critical value within the U.S. ecosystem. Definitely greater than 40% of the U.S. economy runs on them, as well as greater than 40% of employment. And what we're seeing there are some underrepresented segments within the SMB economy, specifically Latinos, specifically minorities, and those could be a huge unlock for U.S. economic growth, not just in terms of local growth, but also as we start thinking about the diversity and innovation that we can bring to the system, the U.S. economy as a whole. And we are very excited to be partnering with small and medium businesses across the board, all sizes and shapes, to support that growth.
All right, so you know that we have been talking about the inequalities in terms of helping small business, but in particular, small businesses run by minorities, and pick, your way of kind of dividing out that group, whether it's run by blacks, whether it's Latinos, whether it's women. So I'm just curious what you are finding that you are doing today, Aparna, that actually moves the needle here.
Yeah, absolutely. So what we're finding first off is, one, there's good optimism in these minority populations. Over 78% of them are saying they're better off today, and they indeed are, than they were last year. That's a whopping 18 percentage points over the non-minorities. That's a great story. But what we need to be doing is making sure that we continue building on that realistic optimism. And they have all the same needs as other businesses, but SMBs, especially, as you can start thinking about their extra special needs, it's all about access. And access comes in three ways: capital, They definitely don't have those deep pockets, especially the minorities. So we've got to make sure that they're not needing to dip into their personal savings and they're not worried about living from one bill to the next. The second really is about how they bring in good workforce and skilled workforce. And the third, which really helps with both the capital as well as the workforce and helps them thrive, is technology. Now, the good news is they are leveraging technology already. Over 40% of them, much greater than the non-minority SMBs, are seeking the right kinds of technology for innovation, for growth, and for efficiency. And the need there really stems from, hey, where do we go to find that technology? How do we know what to use, where to use it? A whopping 80% per our survey for the Latinos is telling us that whopping 80% wants access to folks who can help them get to the technology. That's really the critical linchpin in getting them to where they can be on a level playing field with the rest of the businesses.
Well, I always think about, when we're talking with someone like you, Aparna, obviously small business, that's a big part of your business as well, right? Obviously playing with big companies, but also small business. What's interesting is I recently talked with the administrator of the Small Business Administration at Milken, and we did a panel there. And, one of the things we talked so much about was capital. And I do wonder how you guys think about it at Verizon of being maybe more of a partner on the capital side of things when it comes to small business, because especially when it comes to minority, in 2023, just 32% of Black owners were fully approved for a loan or line of credit compared to 56% of white entrepreneurs. Black, Latinos, others just not getting the same access to capital within the established system. So how do you think about that? I understand the importance of technology, but a lot of times it's just having money to pay all the bills.
Yeah, absolutely. And as I was saying, the need is absolutely acute. So a couple of things that we are doing. Number one, technology does help with sort of lessening the burden on capital. If you're using tech the right way, you can be doing things a lot more efficiently, differentiating and bringing in the revenue. And we come in a big way there. But there's a second piece as well. So we partner with our CSR, our Corporate Social Responsibility Group, and we have a platform called the Verizon Small Business Ready platform. And one of the unique things this platform does is it allows for these businesses to learn how to go seek out capital, learn how to go seek out funds, either federal funds or any other funds. And we also help seed some of these businesses in a good way. We're really proud that over 300,000 businesses, we just crossed that mark of 300,000, are leveraging this platform to seek out the right kinds of resources for that access to capital. We can continue doing more, but we're proud of where we are at today there.
Well, speaking of access, I got to ask how you think about pricing when you price the plans that you offer from Verizon to these small businesses in the context of these businesses being, one, small businesses, two, being strapped when it comes to cash, and three, not necessarily having the access to capital that other business have access to. So how do you think about that in your pricing strategy? Because yes, you're a business, you're a publicly traded company, you have metrics that you have to hit, but at the same time, you need to serve customers in a way that will make sure that they choose you rather than competitors.
Absolutely. And I think I called out earlier too, these small businesses come in various shapes and sizes, different verticals, different needs stemming from that. So before I talk about the pricing, it's really thinking comprehensively about the technology needs and making sure that we know and they know that one size doesn't fit all. So what we tend to do is make sure that we talk to that customer locally, understand what their needs are. And because we are serving the majority of the SMB population, we know where we want to start them in terms of the technology needs. What is it that they need in terms of connectivity? Cybersecurity, such a huge opportunity there, right? Especially for small businesses as they're thinking about ransomware attacks and such. And then also collaboration tools, and finally digital tools. So we make sure that we are understanding their needs. We start them where they're at, and then we grow with them. What we also do is, especially for small, medium businesses, we have special programs, and we also have, every 6 months, we bring in a SMB days week where we bring in these SMBs, we do a tech check, and we give them special pricing, special promo, so they can start off and build from where they're at. And we're pretty excited to see just how much these companies are thriving and then growing with us.
I'm curious too about I want to end with the outlook, because that's what we're focused on here at Bloomberg. We're trying to parse through the minutes from the Federal Reserve's most recent meeting to get an understanding of how members of the Federal Reserve are thinking about the economy. Give us a broad strokes view on how business is for you and how that's reflective of the economy. Just 30 seconds left.
Yeah, so we definitely see a little bit of the headwinds coming in from overall economy, but the outlook is good, especially for the customers, the businesses that we work with that are leveraging technology, and that is the key. The more you use technology, the better your outlook is going to be, and we see that positivity in the customers we serve.
All right, going to leave it there. Hey, listen, good to get some insight, though, into what's going on in the small business community. As we know, we talk about it a lot here in terms of the importance to economic activity and outlook.
And I knew when I saw this interview, I had to go to you to ask you about what you talked about at that Milken panel that you had.
Well, this is what we talked about
just a couple weeks ago.
And it was about durability, viability, access to capital, because all of this kind of stuff. And technology was a big part of it, too, I will say, that having access to that to help kind of build out their platform. So I appreciate Aparna joining us. She's Chief Revenue Officer of Business Markets and SaaS over at Verizon Business.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, everybody, just under 18 minutes to go until we ring the closing bell on Wall Street. And of course, a little bit longer than that till we get to about 38 minutes until we get to NVIDIA earnings. Having said that, we did get some Fed minutes. And so we've been thinking a lot about the economy, where monetary policy goes, what happens to the Treasury curve. So we've got a perfect guest for you. Let's get to it. Dr. Katy Kaminski is back with us. She's Chief Research Strategist and Portfolio Manager at AlphaSimplex Group. She is with us from Cambridge, Massachusetts. How are you?
Good. I mean, it's a little bit of a red day for a lot of people out here today, but otherwise it's a good day.
I mean, those
Sunny.
days have to come every once in a while. They can't be green every day, Katy.
All right. Wait, was there anything from the Fed minutes that you found interesting and kind of relevant to your world?
I mean, I think the thing that's the most interesting is we keep seeing this wait and see narrative, and it's not wavering. And so I think that of course gives people pause. And, you see stocks and bonds down today as a result. And you also saw UK inflation not really doing much for us either. So I think the story is still there. Let's keep waiting.
Well, is there a point when wait and see just becomes the norm, and it meaning that this is it, folks, and it doesn't get any better? I mean, you continue, I think I'm looking at some Bloomberg stories just over the last week or so. You continue to believe that we are far from declaring the inflation fight from being over. So I'm just wondering, is this maybe as good as it gets in terms of inflation? I don't know. Where are you thinking about this?
This is a really good question. And honestly, the signals that we have been seeing all spring, and I guess into summer now soon, have really been consistent with this idea that inflation is not really going anywhere yet. And when you look at stocks and bonds and how they're trading, even taking today, they're still trading with positive correlation. You're seeing that stocks and bonds down on the same day. You're also seeing signals in yield still consistently short. And you're seeing a very, very bipolarized positioning from a technical perspective that suggests that the market is still moving in this higher for longer, wait and see kind of environment. And we haven't seen any indication of that changing at any time soon. So I think time is going to take longer than a lot of people think for this to move ahead.
What do you think, though?
Don't say data dependent there, Katy.
I think, no, I'd say it's, okay, now I'm going to say it's data dependent because you said that.
It's okay. It's okay.
Yeah, I do think that the real challenge out there is that until we can actually see inflation at a lower level, that puts a lot of pressure on whether or not we can see any cuts. And if we're going to see cuts, that could be kind of a strange scenario in history that you don't have inflation down and then we have cuts. So I kind of think that they're leaning more towards, we don't want to do something that might be the wrong choice. As a result, we're not seeing enough evidence that things are restrictive. So restrictive may become where we are now, may become the norm until we see otherwise. So I'd rather wait and see than see otherwise. I don't know how you feel, but that's definitely my camp, is I'd rather wait and see.
Well, Tim's been making fun of me because yesterday I did
the countdown is on
to the blackout by the Fed speakers.
I think we're 10 days away.
10 days away and counting, folks. And then it's a little bit more until the next Fed meeting. Tack on a few more days to that. I don't know. It is kind of this funny little world we are in. And, we were kind of excited when somebody said NVIDIA has taken over. What's the most important thing, right? In terms
Jay Powell, at least right now, sort of the most important thing to watch. I mean, we'll see what happens today, Carol, but
it was
no question the Fed is still front and center.
Yeah, but it was excited for someone to say, no, NVIDIA is really what matters right now. I don't know, Katie, in your world, when I think about the 10-year, right, we always remind you when you were talking about 6% on the 10-year. Have we topped out when it comes to, what am I looking at, a 10-year today that is at what, 442? What's the top for you right now? Do you have a range right now?
I think that people are still really seeing 5% as that sort of peak point. We're still really focused on, you hit that last year. The question is really going to be what you see with inflation. I think a lot of people are underestimating upside risk there. If we started to see the things that have really made me nervous, although today that's the total opposite, is copper prices, gold prices, commodity prices have moved a lot throughout the spring. And I think that made me very nervous about this idea that everything was just going to sort of go back to normal quickly, that it was going to take time. So you could see higher rates, especially if we see a policy issue in terms of we cut rates and then inflation spikes. I think that's a scenario that nobody wants. That's why I'm not ever giving up on the 6% at some point, but maybe I just need a longer window.
What about a window for, when you say 5% is the range right now, does that mean we return to 5% in the near future, or us touching 5% last fall was the top?
Well, we definitely got a little head fake towards that recently, as you know, in April, and that was just basically on slightly worse CPI than people would have liked. And so imagine what could happen if you actually saw CPI even higher, or sort of indications that we had more upside risk in inflation. So inflation has the ability to move rates significantly. So I'm definitely not, completely downplaying that. I think we have to watch what happens with inflation, and we have to kind of accept that bonds and yields may be higher for longer, and that has real implications for investment.
We had a couple of alerts today. One, an ex-Apollo partner seeing cracks emerging in the private credit boom. I think Mike McKee said that private credit came up in the Fed minutes. Just when we think we've figured out all the things to worry about, something hits us, from behind, and we are caught off guard, Katie. There are things out there, maybe it's private credit, I don't know, that could certainly upend everything and change the dynamics here, certainly for what the Fed might need to do.
Oh, definitely. And I think that's the challenge let's take the, corporate housing as an example. All of these sectors, we've been worried about them for quite some time with higher rates. And I think the real question is what doesn't work in this environment? What breaks? And I think we're all looking for that, but until we actually see ex post, it's going to be hard to know. I know that housing sector came out with interesting data today, with just how low inventories are, but at the same time, the prices haven't gone down.
Right,
so,
exactly.
Where do we go from here? So I think a lot of people are looking for those cracks in some of the obvious places, but unfortunately, sometimes it's the less obvious places.
All right. Already looking forward to next time. Katie, be well. Katy Kaminski, Chief Research Strategist, Portfolio Manager over at AlphaSimplex Group, joining us here on Bloomberg Businessweek. Goldman Sachs Group CEO David Solomon said he currently expects that the Fed will not cut interest rates this year amid an economy that's proved more resilient thanks to government spending.
Well, there you have it.
Just another voice.
We'll see what happens.
This is the Bloomberg Business Week podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.